Welcome to our deep dive on health savings accounts. If your health plan is HSA eligible, using an HSA can be fundamentally superior to a standard taxable investment account. In this video, we will clarify eligibility, bust the after-tax myth, explain the triple tax advantage, compare payroll versus direct contributions, and give you a clear action plan. Let's begin, and then we will build toward practical steps you can take today. Here's what we'll cover: eligibility requirements for HSAs, the truth about direct contributions and taxes, the triple tax advantage, the difference between payroll and direct contributions, a step-by-step action plan, and 2 quick quizzes to cement your knowledge. With that roadmap in mind, let's proceed to a quick but important disclaimer. This content is for educational purposes only and is not tax, legal, or investment advice. Your situation may differ. Consult a qualified professional before making decisions. With that context, let's smoothly transition into determining whether your plan is HSA eligible. To contribute to an HSA, you need coverage under an HSA-eligible High Deductible Health Plan. You cannot have disqualifying first-dollar coverage, such as certain PPOs, or a general-purpose flexible spending account that pays before your deductible. You cannot be enrolled in Medicare, and you cannot be claimed as a tax dependent by someone else. If you meet these conditions, you are HSA eligible and can open and fund an HSA. Next, let's address a common misconception about how taxes work with direct HSA contributions. Many people think direct HSA contributions are after tax and therefore pointless. That is incorrect. While direct contributions are made from money that has already been taxed, you later claim an above-the-line deduction for the full contribution amount using IRS Form 8889 when filing your tax return. This deduction reduces your taxable income, making the contribution effectively pre-tax. Now that we've corrected the myth, let's examine why HSAs are uniquely powerful. The triple tax advantage. The HSA uniquely offers 3 distinct tax benefits. First, contributions reduce your taxable income. Second, investment growth within the HSA is not taxed. Third, distributions used for qualified medical expenses are tax-free. Additionally, after age 65, you may withdraw funds for non-medical purposes without penalty. Those distributions are taxed as ordinary income, similar to a traditional retirement account. This combination is something a standard taxable brokerage account cannot replicate. With that foundation, let's test your understanding with a quick question. Quiz time. Which of the following is not part of the HSA's triple tax advantages? Tax-deductible contributions, tax-free investment growth, tax-free withdrawals for qualified medical expenses, or automatic FICA tax avoidance on every contribution? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is D. FICA savings generally apply when contributions are made via employer payroll deduction. The triple tax advantages are tax-deductible contributions, tax-free growth, and tax-free qualified withdrawals. Now let's compare payroll deduction against direct contribution in more detail. With payroll deduction, contributions are typically exempt from FICA taxes and appear automatically on pay stubs. And some employers also contribute to employee HSAs. With direct contributions, you will not avoid FICA taxes, but you still get an income tax deduction via Form 8889. Direct contributions are necessary if your employer does not offer payroll HSA contributions, and they can provide flexibility in timing and provider selection. To visualize your choice, let's look at a process diagram next. This diagram starts with whether the employer offers payroll HSA contributions. If the answer is yes, the recommended path is payroll deduction, which saves FICA taxes. That leads to investing within the HSA and the standard distribution options, including tax-free medical reimbursements and post-age 65 non-medical withdrawals taxed as ordinary income. If the answer is no, the path leads to opening a self-directed HSA, which does not provide FICA savings but still qualifies for the income tax deduction and the same investing and distribution options. Both paths ultimately offer the triple tax advantage on medical spending, with the primary difference being the FICA savings through payroll. Here is a step-by-step plan. First, verify that your plan is HSA eligible. Second, determine whether your employer supports payroll HSA contributions. Third, if payroll is available, set up automatic contributions and investment elections. Fourth, if payroll is not available, open a self-directed HSA, contribute directly, and remember to file Form 8889 with your tax return to claim the deduction. Fifth, choose low-cost, diversified investments consistent with your risk tolerance and time horizon. Sixth, save all medical receipts and store them in an organized system. Seventh, consider paying medical costs out of pocket while allowing the HSA to remain invested, and later reimburse yourself for those documented expenses. Next, let's compare HSAs versus taxable accounts side by side. This table contrasts HSAs with taxable brokerage accounts. HSA contributions reduce taxable income, while taxable accounts use after-tax funds. Growth in HSAs is tax-free, whereas taxable accounts incur ongoing taxes on dividends, interest, and capital gains. HSA qualified medical withdrawals are tax-free. After age 65, non-medical HSA withdrawals are taxed as ordinary income without penalty, similar to a traditional retirement account. Payroll HSA contributions may also save FICA taxes. Both account types require record-keeping, but HSAs require saving receipts for qualified expenses. Now let's go deeper on the receipt strategy that many investors use. A common approach is to pay eligible medical expenses from cash while leaving HSA funds invested. You must save itemized receipts with sufficient detail, including provider, service, date, and proof of payment. You can then reimburse yourself from the HSA at a later date using those saved receipts, which makes the distribution tax-free. This approach allows more time in the market for tax-free compounding while retaining the flexibility to take cash later. To implement this effectively, store receipts digitally with a consistent naming convention and backup. Next, let's test your understanding again. True or false? After age 65, you can withdraw HSA funds for non-medical expenses without any taxes or penalties. You may pause the video now to consider your answer. We will discuss the answer in the next section of the video. The correct answer is B, false. After age 65, non-medical HSA withdrawals avoid the penalty, but they are still taxed as ordinary income. Medical withdrawals remain tax-free. With that clarified, let's consolidate the key takeaways. The key points are as follows. First, direct HSA contributions are effective because the Form 8889 deduction makes them effectively pre-tax. Second, HSAs offer the three core tax benefits: deductible contributions, tax-free growth, and tax-free qualified withdrawals. Third, payroll contributions can also save FICA taxes, while direct contributions typically do not. Fourth, the receipt strategy can preserve tax-free compounding while allowing future reimbursements. Finally, for long-term planning, HSAs can function like a stealth retirement account for medical costs, and, after age 65, as a taxable retirement distribution source for non-medical needs. Next, let's wrap up with a concise summary. In summary, if you are HSA eligible, an HSA can offer superior tax efficiency relative to a taxable account. Direct contributions remain powerful due to the Form 8889 deduction. Payroll contributions add FICA savings on top. Invest according to your plan and keep excellent records so you can reimburse qualified expenses tax-free later. Finally, let's close with a thank you and a quick call to action. Thank you for watching. Please like, share, and subscribe if you found this helpful. And share your HSA experiences or questions in the comments so we can help each other learn more.